business buying friends. Welcome to Cash or Crash. I'm Della Kay, your neighborhood CPA, and I'm here to help you navigate the potholes of buying your first JOB. Yep, buying your first mom and pop small business that you can operate with built-in customers, automatic product market fit, and instant profits. Side gig struggles, corporate handcuffs, analysis paralysis on where to even start. All that shit can eat our dust. On each episode, we'll swing by a different business that's for sale. Is it worth your hard-earned cash, or is it more likely a deadly crash waiting to happen? We'll look at profit, sales, industry, and all the things. Kickstands up. Let's ride this one out.
Could you leave your corporate job to run a chocolate factory in Florida? Let's find out. Hey ladies, this is Della Kay, your neighborhood CPA, and we're here to tear up another business listing. Each one is like a new road trip. But does it end in a pile of cash or a nasty little crash? We'll learn, turn, and burn and dive deep so you can do the same on your own listings. Hold on tight, because here we go. I picked this first listing because it's a great example of a well-priced, perfectly positioned, delicious deal, a small chocolate factory in Florida. The whole listing is shown here, but we'll focus on the highlights. This one is very tempting. It's labeled as a well-established, highly profitable chocolate gift basket business. Handcrafted chocolates, brownies, and cookies. This is a chocolate factory located in Miami, Florida. The asking price is $550,000 plus $60,000 for inventory. Very common that they've split this up. They're claiming annual revenue of $780,000, and the cash flow, or STE, or money going directly into the owner's pocket, is supposed to be $197,000. Now, the fastest way to figure this out is with my rapid fire listing review. 5 easy points we can break down in 5 minutes or less. Step number 1, find the profit margin. Step number 2, calculate what the loan payments would be with this purchase. Step number 3, analyze the loan coverage. Step number 4, compute your personal salary requirement. And step number 5, figure the sales price multiple. 5 easy steps in 5 minutes or less. Now, let's slow it down a bit and dive into each step of the rapid fire listing review with the info provided for our chocolate factory. The first step is to calculate the profit margin, and we do this by taking the cash flow and dividing it by the gross revenue. Now, in my world, anything above 15% or so has potential. So what is this chocolate factory's profit margin? The annual cash flow is $197,000 from the listing, and the annual revenue is $780,000. So $197,000 divided by $780,000 is about 25%. A profit margin of 25% means that for every $1 of revenue generated, the owner is putting 25 cents into their pocket. That's a pretty strong number. Some industries will have much higher standards, while others, like restaurants, will be much lower, maybe even around 10%. Now that's going to put a little fuel in our tank as you see the gauge move up to about 1/8. Let's see what else this deal can provide. Now, step number 2 in the rapid fire listing review is to calculate the SBA loan payments. Now, there are lots of ways to structure your deals, and an SBA loan is only one of them. I'm not even saying it's the best way, but it's a great baseline for review purposes. There are also several SBA loan programs, but for this conversation, we're talking about the SBA 7A specifically for business buying. Now, we're going to use the standard of a 10-year loan and an interest rate of 9%. Of course, interest rates do vary, but this is close enough for our conversation. Now, use any amortization calculator and punch in 9%, 10 years, and the list price of $610,000. The loan payment for something like this would be about $7,700 per month, or around $92,000 a year. Now, before you freak out and think there's no way you can possibly afford nearly $8,000 a month, you have to remember that these payments are meant to come from the business. The business must be able to pay for itself. And you don't qualify for this loan based on your job or your W-2. The business qualifies for this loan. That's the beauty of buying an existing profitable business. So the third point of our rapid fire listing review is exactly that, loan coverage. And the banks do have pretty strict guidelines. They usually like to see enough free cash flow to cover the annual loan payment 1.25 times, or maybe more. So, can the cash flow of this chocolate factory cover the loan payments? Again, the cash flow from the listing information is stated at $197,000 a year. We calculated the loan payments at $92,000 a year. So yes, the chocolate factory can indeed pay for itself. The cash flow is way more than the annual loan payment. But what's the loan coverage ratio? How many times can the cash flow cover that loan payment? Well, 197 divided by 92 is 2.14. It's fantastic. Our fuel tank is really filling up now. Now, don't go anywhere, ladies, because this is where new buyers totally crash and burn almost every time. I've seen it over and over. They get excited about the deal itself, but remember, the goal isn't just to buy any old business. The goal is to buy a business that's right for you and your family. And that slippery spot on the business buying road is the salary replacement factor. The fact that the business can pay for itself is a fantastic starting point. But it's only the first part of a good deal. In addition to making that loan payment, this company must be able to pay you, and not just pennies, but a good living wage. That's point number 4 on our rapid fire listing review. Covering your current salary is the minimum requirement. Buying a business is your chance to buy a whole new lifestyle. So if you're living on $75,000 a year, don't buy a business that can only pay you $50,000. On the flip side, don't get too big for your britches either, sister. What I mean is, if you're currently at $75,000 of income, $100,000 would be a fantastic raise, but don't shoot for that $1 million paycheck on your first deal. You've got to set yourself up for success. So back to our chocolate factory. We take that cash flow of $197, subtract the loan payments of $92,000, and that leaves us about $105,000 to either pay ourselves as the new owners, or invest into growing the business, or possibly to pay that loan off earlier. Now, I don't know if you can live on $105,000 a year, especially in Miami where this is located, but it is interesting. Again, that loan will be paid off at some point while you're also growing the business, which will put even more cash into your pocket. All right, so this deal's looking pretty slick so far, but now that we've covered the lifestyle piece, let's talk about what this business is really worth. That brings us to the 5th and final point in our rapid fire listing review. Now, as good as this business looks, it's obviously not worth millions of dollars. Or maybe it's not so obvious yet. You've probably heard the chatter about price and multiple and STE, but what does it all mean? When we talk about how much a company is worth or how much we're willing to pay, we use a term called multiple. And this is usually a multiple of SDE, seller's discretionary earnings, which basically means the profit or cash flow, the money that goes into the seller's pocket to spend as they see fit. So the formula is price divided by cash flow. The price of the chocolate factory from the listing information is $610,000. The cash flow is $197,000. So we end up with a multiple of 3.09. Easy math, right? But what does it actually mean? Well, it varies. It's kind of like the profit margin we talked about in the beginning of the episode. We expect to see different profit margins depending on the nature of the business, and we expect to see different multiples based on different types and sizes of companies. A good rule of thumb for the small brick and mortar companies that we're driving by is that a multiple of 2 to 3 is probably reasonably priced. Now, that doesn't mean we ignore everything that's a little overpriced, but we don't want to be too far off from the owner's expectations either. For me, in this listing, a 3 looks like a win and adds more fuel to our business buying tank. Let's take a quick pit stop and see where we are with this company. Profit margin? Check, a strong 25%. Loan payments? Check, totally doable at $92,000 a year. Loan coverage? Check, 2.14 times coverage. Salary replacement? Maybe, maybe not. It all depends on your personal situation. Multiple? Check. 3 times sales price. And of course, I have a spreadsheet to help with all these rapid fire listing review calculations. DM me for your copy. Now, there are other subtleties that go into analyzing a deal, but at this point, we're trying to decide if this listing is worth our time or not. For me, this looks like a pretty full tank. So listen, ladies, I am totally here for all of you DIY deal divas. You've totally got this. And that's why I make all the free content that I do. But if you're staring at a listing and a couple years of tax returns and you're thinking to yourself, what the heck do I do next? I've got you, babe. I'll do a private review and tell you exactly what's going on with this listing. Because if you know me, you know I love me some tax returns. Now, the numbers have to work, but there's still more to it. Is this the right business for you? Does it need your skills and connections? Can you take this company to the next level? Let's see what other tidbits are in this listing. It was established in 1980. Have you ever heard of the Lindy Effect? It's a very important concept in business buying. The longer something has been around, the more likely it is to continue to be around. They have a long-term, reliable base of both corporate and individual customers. Knowledge of chocolate making need not needed, as a semi-absentee owner is happy to train. Yeah, they always say they're semi-absentee. Sure, Michael. Get the details on this, ladies, because you're about to step into their boots and ride their ride. They have 5 full-time employees, 5,500 square foot factory plus retail space, and 2 high-speed enrobers and all the other equipment required. My CPA hot take? This could be your chance to ditch your stuffy corporate job and live a life of sunshine and chocolate, minus the crappy emails from Steven in HR. Ladies, buy the lifestyle that you crave. So what's your verdict, friends? Is this a cash or a crash? Do you want to buy this business? Should I buy this business? Or maybe we should buy this business together, because I'd love to be your business buying partner. Now listen up, just in case no one has told you today, ladies. You can absolutely do this. You can buy a small business. You are strong enough. You are brave enough. And every mile that you ride is proof of this. See you on the next trip where we do it all over again.
Truth with any listing is this: you've got to dig into those financials to know for sure. But my CPA hot take: number 1, always do your own due diligence. Number 2, always base your decisions on tax returns, not just financial statement printouts. And number 3, that sales memorandum and financial reconstruction from your broker, that's nothing but a sales document, I promise you. Should I sign an NDA and get the goods on this business? Should we buy this business together? Drop your thoughts below. If you enjoyed today's ride, give this video a thumbs up, subscribe, and share it with your crew. And I'll see you on the next Cash or Crash. Ride safe and peace out.